Good afternoon. It's February the 16th, 2024. Welcome to BizTech's Asian Midday Market Watch. I'm Jeffrey Halley, and today our guest is Kelvin Wong, Senior Market Analyst at Oanda in Singapore. Kelvin, good afternoon.
Yeah, hi, good afternoon to you, and good Friday, Jeff.
Oh, it is too. Always happy on a Friday. Before we get into it, let's have a look around at regional markets today and see how they've been performing. The Nikkei 225 is having another spectacular day, and we'll talk about that in a moment. It's up 1.18% today. Shanghai remains closed today for the Lunar New Year holidays. The Hang Seng in Hong Kong is up nearly 2.1%. Down in Australia, the ASX 200 was up 0.66%. South Korea's Kospi was up 1.1. Well, it's just jumped to 1.23% now. It's having another spectacular day with Japan. Singapore, another wonderful day as well, up 1.41%. And Kuala Lumpur, the KLCI is up 0.17%. Kelvin, what do you make of that price action today so far?
Yeah, so if you look at it on an intraday basis, it's definitely on a bullish tone. So also due to the fact of the external factor, especially out from US. So as we know that at the early start of the week, this week, we do have a kind of a negative risk-off environment due to that shocking, hotter than expected CPI data. So what came back over here is that the bullish tone actually revived in the US market by that mentality, we call it looking for supports to actually get bids coming in, which is positive for the major US stock indices. So what's encouraging in terms from the bullish camp yesterday was the release of that weaker than expected US retail sales figure. So that actually kind of counter-react or counterbalance with the hotter than expected CPI number, keeping that US Federal Reserve Fed dovish pivot still alive. So the only big question I think market participants got to actually watch out for is when will be the start of the first rate cut that is primarily in the market participant minds right now, that's been keeping on pushing backwards instead of forward. Initially, we are talking about as early as March, which is next month. Then right after FOMC is being pushed to May, and after that hotter than expected CPI data is being pushed now to June. So pretty much interesting to see. And also, do not forget over here is that the US 10-year Treasury yield also plays a much important role in also determine that risk-on, risk-off behavior, because due to the cost of funding that is directly tied to the US 10-year Treasury yield globally. So yesterday, the US 10-year Treasury also did a bit of pullback as well, that is supporting this risk-on behavior that we start to spread through the Asian session today.
Great stuff. Yeah, I guess you just have to respect the momentum, and the markets are clearly looking to buy any dip, even after news that doesn't quite fit the Fed easing sooner narrative. Kelvin, let's look at the Nikkei today. The Nikkei 225 is approaching its 1989 all-time high. So if you bought in 1989, you'd just be out breaking even. It's been a wait. Yet the data this week shows that Japan has fallen into a technical recession. So we have a technical recession, but near all-time highs in the Nikkei. Can you explain that dichotomy to the viewers?
Yeah, so I believe that a lot of market participants or watchers are also scratching their head. But if you dive into this deeper picture over here, we got to understand what is the crux that is actually driving that technical recession, which was the big Q4 figure last year in Japan. So if you look in dive into data, primarily domestic consumption, or say private consumption, is far more weaker than expected. And don't forget, domestic consumption right now actually plays a bigger concentration in determine the composite of the entire Japanese economic growth versus net exports. So that was in the past. So what's interesting over here is that I did a chart where I plotted the real consumption growth year on year versus the dollar yen, the inverse of the dollar yen. So what you could see over here is that the last 3 to 6 months of decline in that real consumption growth in Japan has been directly correlated pretty much significantly with this weakening of the yen itself. So if you look at the situation over here, is that previously in the past, we started to see very key Japanese data figure that came in very weakly, means way beyond expectation. You tend to see the yen weaken significantly as well. That means we talk about dollar yen spiking up due to the fact that market has a belief that BOJ will keep continuing on their ultra dovish stance that has been kept for since 2016 or 2017. But that doesn't yet, that particular phenomenon or behavior didn't actually occur yesterday. So what in fact interesting occurs there after the release of the part of that technical recessionary GDP number in Japan, the yen actually instead did the inverse. It actually strengthened intraday against the dollar by close to positive 0.3%. So why is the reason so? Because if you look at the situation right now, the current stance for BOJ based on its the latest monetary policy meeting, especially from the governor public press conference, they're actually pretty much confident on Japan exiting from its deflationary scenario in the last 20 years or so. And they are looking to actually now getting rid of the negative interest rate. Okay, so what it means that over here is that if the top policy makers are confident about deflation getting more and more getting remote into this getting more and more lesser or resurfacing back in Japan, and then pretty much confident of getting interest rate up to at least positive level rather than keep it negative. That's actually could actually counter a positive counter reaction force towards real consumption spending. So that actually explains why the Nikkei 225 actually continue to surge at this point in time. And don't forget, the previous Q4 real consumption decline was actually due to what I call external cost push inflation. That means if we also due to the fact of a weaker yen. So if the weaker yen managed to get subsided, that means due to normalization of Japanese monetary policy, that could actually prevent or offset any potential global external inflationary factor that the Japanese consumer could face as well.
Great stuff. Let's take a look at Singapore now. Non-oil domestic exports rose 2.3% month on month, released this morning. That's another cracking number, bringing it to 16.8% on an annual basis. Given that economic activity and GDP growth are muted, to say the least, in Singapore at the moment, do you think this trend is sustainable?
Yeah, because if I look at it right now, the year-on-year figure is very likely due to a low base effect because the last year ago, the month of December is pretty low. So that should explain that surprising blip up over here. So given the low base effect over here, we cannot be certain for sure that whether this upward trend in NODX net export is sustainable in this Singapore economy. And do not forget over here is that Singapore economy is also very much dependent on growth in China, especially in the last few years. So for China itself, the risk of deflationary spiral is still there, especially because to see how Chinese policymakers going to tackle this situation. Of course, at this point in time, there is still no clarity on the China's top policymakers in directly, we call it injecting a more forceful direct fiscal stimulus. So they are still in favor of doing bit-sized measures to actually counter this. So with that scenario coming into play, and do not forget over here is that US-China rivalry between this tech war is still intact. And especially do not forget over here is that we have that controversial Trump as well. So the last few weeks, he did mention that one of his key policy is to actually invoke another round of trade tariffs against China. So he's talking about a figure about 60%. So that's a pretty high number. So, but for sure, it does, whether will it be implemented, but if his numbers are getting higher and higher in terms of popularity, that could actually inflict a negative sentiment into the consumer and business spending in Singapore as well.
Okay. Right. Okay. All to be watched, I guess. 2024 is going to be an exciting year.
Yeah,
look, Kelvin, very, very briefly, US PPI numbers tonight. What are you expecting, and what are some possible market reactions around that data?
Yeah, for sure, because market will be looking at this number quite scrutinizing as well, especially the surprisingly hotter than expected CPI that was released earlier this week. So if you look at the trend of the PPI number excluding food and energy, it has been in a downtrend, growth deceleration since the middle of last year. So the December figure year on year is, I think, it came in at 1.8% year on year. So market is not expecting the growth to actually decelerate to 1.6% year on year. So for sure, if we start to see another round of very surprising number, let's say, for example, if the PPI starts to actually dip up back to about 2% year on year, that could actually see the US 10-year US Treasury year rebounding back again to around like 4.3% level. So that could actually potentially create a bit of a negative knee-jerk reaction on the major US stock indices.
So asset market ping pong could continue around these data points. Kelvin, thanks so much for being on the show today.
My pleasure.
We've been speaking to Kelvin Wong, Senior Market Analyst at Oanda in Singapore. And this is BizTech's Asian Midday Market Watch. I'm Jeffrey Halley. This video and podcast will be on our website, www.biztech.asia, as well as our social media platforms. You can also see it on our syndication partners, TV and radio stations and websites. Thanks so much for tuning in.